questions or comments?
Sorry, Jeff.
Yep, please feel free to ask any questions, make any comments as we go. We do have a PowerPoint, but we're not married to it. We can talk about anything and everything because I want to make sure that everybody gets that golden nugget of information that they're looking for their own particular situation. Does that sound good?
Yep.
Okay, Carrie, thanks so much for inviting me in to talk to your group. I am a tax attorney. I've been proprietor of this business here since 2005. Commercial Partners Exchange Company has been around since 1998. We're located in downtown Minneapolis. We do thousands of exchanges every year. We have about 78 5-star reviews on Google+. So I think we're a well-regarded resource in the Minneapolis area for 1031 exchanges, but our practice really extends quite far. We do transactions all over the country, and we do a lot of very sophisticated and complicated 1031 exchanges, in addition to this sort of normal mom and pop transactions. Let's just make sure I can advance slides here. Disclaimer, though I am an attorney, I'm not creating an attorney-client relationship with anyone on this call. You should always consult with your own tax and legal advisors about your own specific situation. Everyone's situation is different, and I'm just doing this for educational or pedagogical purposes. All right, so there was a big scare during the Obama administration, and then while President-elect Biden was about to be sworn in, there was some talk about capping 1031, and that never got any traction. There was a strong pushback from the agricultural lobbyists and the Realtors Association and other groups. So 1031 has been left alone, but it did cause a pretty big scare in 2021 because a lot of people were trying to get their transactions done before gains could potentially be capped. One client of ours was selling like a $27 million property in St. Paul on Larpenter, and he wanted to get his sale done because he certainly had more than $500,000 of gain. And under that proposal, he wouldn't have gotten the shelter that he wanted. We think that 1031 is a catalyst for economic development. It encourages the free flow of capital to the most advantageous investment. We think it's a job creator, and you're only deferring the taxes. You're not excluding them like the principal residence exclusion. So it is it's a winner. The other big thing that has been going on is the QOZs, the qualified opportunity zones. That's an alternative to 1031. I don't think it's as good of an alternative because the tax deferral is perishable. You only get to defer the gains until December 31st of 2026, and then you're going to pay the piper. And likely the piper is going to be paid at a higher tax rate than the current tax rate. So I'm not a big fan of the qualified opportunity zones, except in those instances when you can't do a 1031. Because maybe you're selling a business or a partnership, or you have other gains that aren't related to the sale of real estate, in which case I think the QOZ is probably a good alternative to consider. All right. I don't think we're going to see any tax reform. I think things are pretty much congested and bogged down with the Build Back Better bill. I don't think that 1031 is on the chopping block any longer. But we were pretty scared last year that we were going to be out of business. All right. There was a show with Ashton Kutcher where he was punking people. He was playing practical jokes on them. I sometimes feel like I'm being punked on the phone when people call me up and say, yes, I closed last week on the sale of my relinquished property, and now I'd like to do a 1031 exchange, or I'd like to do one of those 1031 reversals. And it happens with such frequency. It happens on the weekends. It happens during office hours. I get texts from people. It happens with such regularity that I feel like it's got to be a practical joke, but it's not. I think there's just a lot of people that are ill-informed and don't understand that you need to insulate yourself from receiving these proceeds, and you need to set up your exchange before the sale of the relinquished property occurs. It's a really important thing. And we do get calls from people, you know, with emergencies. We're closing tomorrow. We thought we had set up an exchange, or we thought our real estate agent had arranged for that, but they hadn't. So when we have to step into the breach and set it up quickly, we can, but we can't do anything after the fact. Once you've transferred the benefits and burdens of ownership, you've conducted a taxable sale and the game is over. Just sort of as a baseline, because we may have some people that are unfamiliar with the deadlines in a 1031 exchange, I do want to emphasize that you have to identify your replacement property in 45 days after the date of sale. And Carrie, I'll just ask you a question. Is it a hot real estate market, or is it a hot real estate market?
It is a hot real estate market.
So, you know, the really good professionals are advising their clients to start looking for the replacement property even before they've sold their relinquished property. Maybe get it teed up, get it under contract early in the process. That 45-day period can be very stressful for clients who are looking to redeploy their money, but they can't get an offer accepted because they keep getting beat out by other competitors. We're hearing, you know, horror stories in Florida where they just can't get a property under contract, and they don't know what to identify. Do they just throw 3 darts at the wall using the easiest identification rule, which is the 3 property rule? You know, people are having a tough time. So you have to think like a chess player, try to tee up that replacement property early in the process. Any thoughts or questions about that kind of particular inventory problem that is out there right now?
And just so I'm sure, does everybody understand sort of the basic premise of a 1031? Does anybody have any questions about what it is? Is everybody relatively familiar? If not, just holler and we'll explain it.
I would love to have just a basic primer on it.
Sure. In a 1031 exchange, you're deferring your capital gains, not only the recapture of depreciation, but also the ordinary capital gains, by redeploying your money into like-kind property. That's real estate for real estate. Typically, it's U.S. real estate for U.S. real estate. And you generally want to buy replacement properties of equal or greater value. So you're continuing your investment into what most investors want is a greater valued property, but at least equivalent or greater. There are 3 benchmarks: value, equity, and debt. You know, you want to buy a property of equal or greater value. You want to reinvest all of your cash into that new property. And to the extent that you were discharged of debt or mortgages on the old property, you need to offset that debt relief with either new debt on the replacement property, or you can also add cash in out of your own pocket to offset the debt relief. In this hot market that we're in, we are also seeing entries that weren't there before. Firms like Morgan Stanley, Ameriprise, Cantor Fitzgerald, Schwab, and other financial services firms are selling properties that are marketed and regulated as securities, but nevertheless qualify for 1031. And so one of the hot trends that we're seeing here in the Minneapolis area is that people are selling properties. A lot of them are long-term multifamily people that have owned properties for decades, and they are fed up with government regulation, rent control issues, prohibitions on evictions, and just high property taxes and difficulties with the multifamily market. They're tired of that. And so they see the Delaware statutory trust or the securitized investments as an alternative that would give them management-free options to complete their exchanges into. Now, when you do an exchange, you have those 2 deadlines I mentioned, the 45-day identification deadline and the 180-day exchange period. Both of those clocks are running concurrently from the day after the closing of your relinquished property. So the day of closing is day 0. These 2 deadlines were not created with your success in mind. The IRS was trying to limit or constrain the number of people getting this tax deferral. And so people say, oh, this is ridiculous. I can't identify in 45 days. And I say, you know what? I agree with you. It's a ridiculous rule, but those are the rules. And if you want this tax deferral, you have to conform your behavior to the Treasury regulations and the code section. So think about what you're going to be doing in advance and try to make sure that you can identify and close within these deadlines. To that end, some people are tying up a buyer and they're saying to the buyer, look, we'll close with you on or before June 1st of 2022 in the seller's sole and complete discretion. But since we haven't found our replacement property that we want to go into, we want to tap the brakes on the closing and hold off on closing with you until we've kind of got something in our sights, or at least have done some more research in the area of our replacement property, because we don't want to be playing musical chairs for 45 days and find we have nothing to exchange into. So continuation of investment, deferral of gains, these are the themes that you can then use in your own life to defer your gains and continue to compound your wealth over time to build wealth. And for the person that wanted the primer, I have lots of clients that started off with single family rentals. They parlayed that into a fourplex, and then later on they parlayed that into 16 units. And then before you know it, they're a good operator and they're able to sell the 16 unit and get up to 32 units and so on and so forth. So over a period of 20 or 30 years, using 1031 and not having the drag of taxation can allow you to build your real estate empire pretty quickly, because you're using OPM, other people's money, in the form of leverage, and you get the benefit of all of this money that wasn't paid to the government in taxes that continues to allow you to compound and increase your holdings. So that's the big picture. Questions about either the 45-day deadline or the 180-day deadline? Yes.
The 180-day deadline refers to the date by which you must close. You must have the property identified in 45 days, but you have 6 months to close.
Basically, 180 days is close to 6 months. And yes, you have to receive title to your identified properties within that time frame. And the only properties that will be considered like kind are those that you properly identified during the 45-day time frame.
Is undeveloped land considered a proper substitute or like kind property?
I believe the answer is yes. There may be some details there that we'd have to ferret out with your accountant. If you're selling appreciated buildings that you've taken accelerated depreciation on, what we call 1245 gain, and you're going into just raw dirt, which is purely 1250 property, there may be a little sliver of gains that you can't offset because you're not getting any 1245 property if you're going purely into dirt. So undeveloped land is like kind, it is real estate, but then within the realm of your relinquished property, you need to analyze if you've only got 1250 gains or if you have a smattering of 1245. Anyone that's done a cost seg study has probably got some 1245 gains.
Also, does this apply to owner-occupied duplexes, for instance? I mean, or is it just an independent rental property that you own?
It applies to property that has been held for investment or business purposes. So let's say that you're selling a duplex that you've owner occupied 50% of, but the other 50% of the duplex has been held for rental business purposes. When you go to sell that duplex, you may be able to avail yourself of two code sections. Section 121, which is the principal residence exclusion, would be applicable to the sale of the owner occupied portion of the duplex. And you may be able to exclude up to $500,000 of gain if you're married, $250,000 if you're single. The requirement is that you have to have owned it and lived in it for 2 out of the preceding 5 years for that portion of the duplex. The other portion of the duplex that you're using for investment or business purposes may be eligible for the 1031 tax deferral. And we can bifurcate your proceeds into 2 buckets. Principal residence bucket that you can do whatever you want with because the gains are excluded up to the threshold amounts. And the other bucket is the 1031 proceeds that would have to be reinvested into like-kind real property that you would identify and close on within the 45 and 180-day deadline. So you can get a split. There's also instances where, and you see this in California, someone has a single family rental that they rented out for years, or they've, let me change that. They've lived in it for years as their principal residence, but then they move out of it and they start renting it. And when they go to sell that property, they may be able to take both the principal residence exclusion because the look back period is 5 years, 2 out of the preceding 5 years. And they also got the 1031 because it's most recently been used for investment or business. So you can get situations where you have both a 121 principal residence exclusion and a 1031.
Hey, Jeff, we've got a question in the chat about what a 1245 gain is.
Some components in your real estate may have been eligible for more rapid depreciation. And typically a multifamily property is depreciated at 27.5 years, but there may be components that are more shorter lived. And if you're taking faster depreciation on the components, then it's considered 1245 property. 1245 gains have to be matched up with new 1245 property. You can't exchange your 1245 gains into 1250 property. 1250 property is typically raw land, dirt, and long-term improvements, the 27.5 and the 39-year lived real estate buildings. No, we're getting pretty deep in the weeds, but you know. Any other thoughts or questions? I just want to make a note about DSTs because there's a trap for the unwary with these securities. If you're identifying a DST and you're trying to use the 3 property rule that says you can identify any 3 properties without regard to their value, you have to scratch beneath the surface of that security that you're buying from your financial planner and determine how many component properties are inside of that DST. If you're buying a DST that's comprised of a portfolio of 7 properties, you have probably broken the 3 property rule right off the bat and may not be able to use that property if you're trying to use the 3 property rule. There is an alternative identification rule that you can use under which you can identify any number of properties, but the total aggregate value of all of those identified properties cannot exceed 200% of the value of what you relinquished. That's called the 200% rule. For example, if I sold a $10 million property, I could identify any number of properties, but the total aggregate value of what I list cannot exceed $20 million in that hypothetical. All right, thoughts or questions before we move on to the next slide?
I do believe also to exchange into, I may be mistaken, correct me if I'm wrong, to exchange into a DST, don't you have to be an accredited investor as well?
Generally, yes. Financial planners can't market these to the general public. It's a consumer protection thing. So yeah, you may have to be an accredited investor. You'd have to talk to your financial planner. By the way, I don't sell any real estate. I don't sell any investments. I'm ultimately agnostic on what you go into. I want to be the humble 1031 administrator taking care of the paperwork and the administration of the mechanics of your exchange.
And if anybody doesn't know what an accredited investor is, it's you have to have a net worth of $1 million excluding your residence.
Or a certain annual income of, I think, $240,000. And then for some types of investors, the accredited investor standard is higher. It's $5 million for irrevocable trusts and corporations.
Okay.
All
All
right.
right.
So a lot of taxpayers that are doing exchanges are only fixated on reinvesting their cash proceeds. If I sold a property for $1 million, I paid off a mortgage of 600,000. I had 400 of cash in my exchange account. They're only fixated on redeploying that $400,000. They think all I have to do is go out and buy $400,000 of replacement property and I'm golden. But they've got the blinders on. They're not thinking straight about the other parts of this analysis from an accountant's perspective. From an accountant's perspective, you got to take your $400,000 of exchange funds and use it to buy a property of equal or greater value. So you'll see item number 1 here is, and we call this the napkin test. It's sort of a distilling these really complex regulations into 3 easy to understand general rules of thumb. If I sell $1 million of relinquished property, I generally got to buy at least $1 million of replacement property to continue my investment. I also have to reinvest all of my net proceeds or equity. And then finally, to the extent that I had debt, mortgages on my old property, I need to make sure that I'm covering my debt relief by taking out new debt on the replacement property or by adding additional cash in out of my own pocket. And today I was talking to a man who had like $3.1 million of cash in his exchange account, but maybe had about $600,000 of debt that had been paid off on his old property. And he was flush with cash. He had sold some other properties they'd paid the taxes on. He said, you know what? I'm probably just going to buy $3.7 million of replacement property using 3.1 of my exchange funds and 600K out of my own pocket, because I just don't really want to take out a mortgage if I don't have to. And so that just illustrates that you offset your debt relief with either new debt or new cash or some combination of the two. But I will warn you, a lot of people only think about the equity. And that is a mistake. Now, if you want to do a partial exchange, that's great. You don't have to buy a property of equal or greater value, but dollar for dollar, to the extent you buy down in value, or dollar for dollar to the extent that you take cash off the table, you're going to pay taxes and recognize the gains, because the first dollars off the table are not viewed as the return of your seed money by the IRS or the return of your basis. It's viewed as the profit dollars, the gain dollars. Now, what if you want to have some cash in your pocket, but you don't want to pay any taxes? How could you conform your behavior to get 100% tax deferral, but still have some cash in your pocket at the end of the day? Today, I was talking to some bankers that are starting a new de novo bank. And I said to them, look, a lot of investors want to reinvest 100% of their proceeds into their new replacement property. But once they bought it, in a later subsequent transaction, they would like to be able to put a revolving line of credit, what you might call a HELOC, on the replacement property in a second transaction to be able to have access to that equity should they have an unforeseen repair expense or vacancy or some dilemma, some problem has arisen. They may need that extra equity because they're buying an unknown commodity, this new property. They don't know what they're getting themselves into. So post-exchange, you can put additional debt on your replacement property as long as it's done in a separate subsequent transaction. And that is kind of the way you can still have your cake and eat it too. I see a couple people nodding their heads. You get it. Good. All right. Thoughts or questions about the napkin test? Just a question. If you're in the business of building your wealth empire, would you ever want to do a lateral exchange into a property of equal value? Most of us that are entrepreneurial are going to take our equity and lever it up to the maximum extent that we can and buy as much real estate as we can. If we're selling a single family or a duplex, we're going to reach for the stars and try to get a fourplex or an eightplex. We're trying to get as much real estate under our management as possible so that when the tides of appreciation or inflation occur, we've got a bigger boat rising in the harbor, right? We don't want to just have a single family rental going up in value. We'd like to have as much real estate under control as possible. So most people are reaching and using leverage to buy much bigger property and reinvesting every penny of their proceeds and then some. Thoughts or questions about the business aspect of investing in real estate? Okay.
I just ask quick, are you able to do an exchange for like a single family into a commercial property?
Yes.
Okay, thank you.
Pretty much any real estate in the United States is going to be considered like kind. So we see people selling single family homes and buying raw land or buying a farm or buying a medical office building or buying industrial property. There's a great degree of latitude within the realm of real estate, what is considered like kind. So just a really crazy example, the Fauché Tower would be like kind to a farm in Decorah, Iowa. The differences between them are differences in grade or quality, but the character of both of those properties is still real estate. Anyone from Decorah, Iowa in the group today? Okay. So let's talk about the disincentive. Here's my hand and I'm going to slap it. All right, that is a disincentive. If I had my hand slapped every time I sold real estate, I would probably stop selling real estate because I'm tired of having my hand slapped, right? So what are the disincentives for selling real estate in a taxable transaction? You know, you've got the federal capital gains rate, which is at 20%. You've got the portion of the gain that relates to your depreciation deductions, because every year that you own real estate, you take that deduction for the theoretical wear and tear on the property. Your basis is incrementally decreased. And when you sell the property, the gains that are attributable to the depreciation are actually taxed at a higher rate. If you've got gains from 1245, like you did a cost segregation study to parse out those components, those could be taxed at ordinary income rates. There's also a tax at the federal level called NIDA tax, net investment income tax. It's 3.8. And for high income earners, they have too much income. So you could have a portion of your real estate proceeds taxed at NIDA on top of everything else. And then in high tax states like Minnesota, California, and New York, we're currently at what, 9.85, I think, in Minnesota is our highest rate. So if you were to have a big tsunami of gains hit your tax return, hit your 1040 in 1 year, you know, between all of these different tranches of taxation, you could easily have a 50% effective tax rate, particularly in states like California. So it's a huge disincentive. The taxes lock you in and discourage you from selling your real estate, unless you have a safety valve like 1031 exchange that allows you to defer all of these gains and continue to compound and build your wealth. And so 1031 really acts as a catalyst to allow capital to flow more freely in our economy. Money in the economy is like blood in your system. You want the blood to flow freely to all of the different limbs and arteries so that you get maximum efficiency. So that's what 1031 is doing, is helping move that capital without the drag of taxation. Questions about that? Okay. So when I talk to people on the phone, I usually talk to them about going from apples to apples. If I'm talking to Holly on the phone and she says, I bought this property, I own it in my own individual name, I would say, well, we want to go from Holly to Holly. We want Holly to have owned the relinquished property, held it for her investment or business purposes. And when she buys the new replacement property, I want it to be Holly that buys that property. And for people that are now married and now have a spouse, they may say, well, I want my spouse to own half of the replacement property. Well, that doesn't work because the spouse that owned the property, we need to use the exchange funds exclusively for that spouse's benefit. And we can't use the exchange fund to buy anyone else's interest in the property, even if you're married to them. And Minnesota is not a community property state, so your spouse doesn't automatically have an ownership interest in your property. Now, you can, if you want, using Holly as an example, have Holly buy the replacement property, but not in her own individual capacity, but in her fiduciary capacity as trustee of Holly's revocable trust. If, as part of her estate planning, she wants to buy it as trustee of her revocable trust, that's still considered Holly, because for federal tax purposes, a revocable trust, because it's revocable, is the equivalent of Holly buying in her own individual capacity. What if Holly is buying a liquor store or a property that has a lot of potential environmental contaminants, like an old dry cleaners building? Holly may say, I need to insulate myself from the liability associated with that real estate. So Holly says, I'm going to form a single member LLC. That LLC will give me liability protection at the state level. But because it's wholly owned by Holly and it doesn't file a separate tax return, it all rolls up to Holly's tax return, it's disregarded. It's completely transparent. The IRS looks right through it and just sees Holly. So the other option that you have, and still be considered going from apples to apples, is to buy in a single member disregarded entity. LLCs are the cliche single member LLC entity, but there are other entities. Partnerships that are wholly owned by one person are effectively the same thing. What is verboten, what is not allowed, is that you can't use your exchange funds and buy an interest in a partnership. A multi-member LLC or an entity that's taxed as a partnership, that is specifically excluded from 1031 treatment. So if Holly says, hey, I'm going to sell this fourplex in St. Paul, and I want to invest in this real estate syndication where they're building a big 100-unit apartment complex, and I'm going to put my money into this deal. Well, those deals are usually set up as partnerships, and what you'd be buying would not be considered like kind because it's not an interest in real estate, it's an interest in a partnership. Nor could you use your money from your 1031 exchange to buy stock in a corporation or stock in a REIT because it's excluded from 1031 treatment. I do think that Holly would have some alternatives if she wanted to buy with another investor to go into a deal as a tenant in common. Holly could say to her co-purchaser, we're not going to be partners in this deal, but we are going to co-own this real estate together. I'll put in half of the cash and I'll own an undivided 50% interest in the deal using my 1031 funds. And the co-purchaser could put in their half of the proceeds needed and own their proportionate share of the real estate. So there is a fine line between a partnership and merely co-owning real estate. And so there are some alternatives that are close to partnerships, but are not considered partnerships, and that still would be considered eligible for 1031. Any thoughts or questions about that? Okay. I deal with a lot of people that already own real estate. They may own a piece of real estate with their 5 siblings because they inherited it years ago. And oftentimes there's dynamics between the siblings that are not so good. Or they may own real estate with business partners, and over the course of time, the relationship between the partners has decayed. Maybe some of the original partners are dead, and now we're dealing with the next generation. The dynamics can change and deteriorate over time. And so a lot of people approach me and say, I want to do a 1031 exchange on this sale of this real estate, but I don't directly own it. I'm in a partnership. For example, I was contacted by a law firm where all of the attorneys had retired, but they still owned the law building that they had practiced law together with, and they don't get along anymore. They don't trust each other. They don't like each other, but they happen to be in a partnership that owns the old law firm building. And so one of the lawyers wanted to do an exchange, but in order to be able to do an exchange, that lawyer would have had to have owned an undivided fractional interest in the real estate. So one idea is to get a hold of your attorney and change the ownership well before the closing. Convert this to a tenancy in common and let some time pass so that you have seasoned that individual ownership interest in the real estate for a substantial period of time. How long do you have to wait after breaking up the partnership? There's a case out of California called Bulker, where a stockholder in a corporation redeemed his stock in the corporation for an undivided fractional interest in the real estate, held it for 3 months, and the IRS came in and challenged Bulker and said, you didn't hold this property for investment or business purposes, or you held it primarily for resale. Either way, we don't think the exchange works. And in that California case out of Bulker, it was the Ninth Circuit, Bulker won. So at least in one instance, we have a favorable decision where 3 months was an adequate holding time after breaking up an entity, distributing real estate out as a tenant in common. There are various techniques, some more sophisticated than others, some crude, for breaking up the ownership of property. And if you are in a partnership or you're representing clients that own real estate in a partnership, this is a planning opportunity to get them in front of their attorney early and to break up the ownership of the property. Just today, I got a call from an attorney, and we were going to break up a property. There were 3 partners, and he advised me that in the process of breaking up the property, one of the partners died unexpectedly. And so that person doesn't have to do an exchange, and they're now dead. Their heirs get a stepped up basis, so they're not as worried about breaking up. But still, some of the partners still want to do exchanges. So they're still going forward with the breakup, but they were planning so far in advance that in the interim, one of the partners died. Let's talk about the step up in basis, because I think this is a good time to weave that into the discussion. Under section 1015, if I were to give my shares in 3M Company to my son during my lifetime, let's say I bought these shares for $10 a share and they're now worth $300 a share. I have a $290 increase in value. Under 1015, when I give that stock to my son during my lifetime, my son takes a carryover basis. He basically steps into my shoes and owns that stock with my low old basis. But if I die and my son inherits that stock, that property upon my death, under a different code section called 1014, my son doesn't take it with the low basis of $10 a share. He takes it with the fair market value. In this case, $300 a share. He could sell the stock the day after my funeral and have no gains, or little or no gains, because he's got a high basis. Well, that's kind of where 1031 gets really fun and interesting, because throughout your lifetime, if you can parlay your investment each time into a bigger and better property, and eventually you die, your kids, your heirs, the way the law is written now under 1014, do not take that property with your low basis that you carried with you from property to property throughout your lifetime. They take the property with a stepped up basis. So I tell people the mantra is defer, 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 die. All right. Another thing I'd like to weave into this discussion is if you want to create family acrimony after your death, if you want to be laughing at your heirs flailing about after your death, give them an apartment building to own together. Invariably, they don't want an apartment building, nor do they know how to manage it. And the siblings will all argue amongst themselves about decision-making, refinancing, leasing. One of the siblings will probably try to have a go at the management while the others all armchair quarterback and criticize them. If you want to make your heirs unhappy, give them an apartment complex. But if you want to make it easy for them after your death, have positioned your investments into securities that qualify for 1031. Go to Morgan Stanley, Ameriprise, Schwab, Cantor Fitzgerald, buy some securities that are easily divisible upon your death. Bobby can take 25 REIT shares. Susie can take 25 REIT shares. Many of these DSTs are designed to morph up into a real estate investment trust or UPREIT. So you're basically getting the equivalent of a REIT, easily divisible, can be handed down to your heirs in small increments, and everybody can just go their separate ways and not have to be intertwined with each other in a single physical property. All right, thoughts or questions about that?
Yes. So are you saying that we can sell a property we own and invest in a property we don't have to manage?
Yes, there are alternatives that are not very management intensive. The management may be as limited as going to your mailbox each month and getting your yield check from your financial services firm. Those are often referred to as DSTs, which stands for Delaware Statutory Trusts. Those are only sold to accredited investors, as Carrie had pointed out, but that's an alternative that's very attractive to people.
And Jeff, you may cover this and maybe things have changed, but you can also exchange into a lake home, right? Couldn't
Well,
you?
we're going to get into that.
Okay. I'm jumping ahead then, I'm sorry.
No, and that's fine. Let's deal with it. I love to go out of sequence a little bit. Whenever you buy as a replacement property, initially has to be held for investment or business purposes. Your mens rea, your mental intent has to be investment or business. So if I buy a rental cottage in Grand Marais and I put it into an Airbnb, VBRO, property management arrangement, and I rent it out, that could qualify for my 1031. What the IRS had a lot of litigation with was people were putting their properties into Airbnb and they were renting them out, but they were also using them extensively for their own personal use. And so the IRS came out with a safe harbor where they said, all right, there's a lot of litigation. We're going to give you some bright line rules. If you follow these rules, we won't challenge that it's being held for investment or business. They said you got a minimum rent it out at least 14 days in each of the 2 12-month periods after you acquire the property. And you have to limit your personal use to not more than 14 days a year or not more than 10% of the time that the unit is actually rented out. So for the first 2 12-month periods, basically 24 months, you should consider yourself on 1031 probation. How many people have been on probation? Raise your hand. Okay, just kidding. You are vulnerable for that 24-month period if you're using lake cabins, oceanfront condos, ski chalets, properties that have the potential for being personal use properties, you're vulnerable for basically 24 months. And so I tell people, if you're going to buy that lake cottage, buy that ski chalet, buy that oceanfront condo in Naples, Florida, you really want to rent it out. You want to walk like a duck, talk like a duck, and then eventually, after you've gotten through that 24-month period, you could convert the property to personal use and use it more extensively for personal use, maybe even use it exclusively for personal use. But for the first 2 12-month periods, watch your P's and Q's. I was just talking to an investor yesterday who is really into the Airbnb market, and he has identified parts of the country where you can have a rental season and get almost 350 days of rental in a year. Smoky Mountains in Tennessee is one of the areas he mentioned on the phone.
Yep.
And, having a longer rental season means that that property is producing cash flow for you more throughout the year. Whereas some areas like Grand Marais, your rental season may not be as long or as intense because people are not as inclined to go to Grand Marais in, January or February. It's just not as fun as it is in the summertime. Thoughts or questions about that?
So with that 2-year period, do you have to prove that you rented it for all but 14 days, or do you have to prove that you tried to rent it?
Under that Rev Proc, you have to rent it for 14 days.
But you have to rent it for only 14 days?
Minimum 14 days in each of the 2 12-month periods.
Oh, okay. I thought you were saying you could only use it for 14 days for personal use.
I also said that too.
Okay.
It's a 2-pronged test. You have to actually rent it out for at least 14 days, and you have to constrain your personal use to not more than 14 days a year, or 10% of the time it's actually rented. By the way, there's some IRS publications where they talk about some examples where you're going to the unit for maintenance and whether or not that constitutes personal use. If you're going to the unit to open it up for the season, turn the water on, dust off the cobwebs, that's not personal use in the eyes of the IRS. So that wouldn't count against you as one of your 14 days.
So in theory, you could rent it for 14 days, you could use it for 14 days, and then for 11 months, it could sit idle. And do you have to show you had ads trying to rent it, or it could just sit idle for 11 months?
Well, what kind of investor are you that you want to leave a property vacant for 11 months?
Understood. I'm just curious what they're looking for and how do they verify how much time you spent there?
Well, ultimately, it's on your shoulders to prove that you're using it for investment or business. And I hate to say that the burden of proof is kind of stacked against you, but it is kind of stacked against you, particularly the Minnesota Department of Revenue. They got on a hot streak because there was a title company in the Arrowhead part of the state that had been incorrectly telling people that they could do 1031 exchanges on their lake cabins that were not really investment or business properties. So the Minnesota Department of Revenue, I think, already has had a successful track record at scrutinizing these 1031s of cottages and second homes. And I believe that they will put your feet to the fire and have you substantiate that it's truly held for investment or business. So having a lot of rental income and having a lot of use of your property for business or investment is probably going to help substantiate you if you're in that uncomfortable audit situation.
So then after those 2 years is done, can you then sell that investment property and not pay the rental capital gains, but just personal?
Well, after you have used it for 24 months for business purposes, you could convert it to personal use. And once it's become your primary residence, now you may be eligible to take the principal residence exclusion, what we call the 121 home exclusion. That is an interesting sort of interconnection between 1031 and the principal residence rules. And it's interesting because it used to be that this was a tax loophole that you could drive a $500,000 truck through, but they changed the principal residence exclusion to only give you a fraction of the exclusion amount based on the number of years that you used it for investment or business and the number of years that you used it for what they call a qualifying purpose in that context, which is principal residence. So hypothetically, you rent out the property for 2 years, then you move into it and live in it for 3 years as your primary residence, you'd be eligible for 3/5 of the $500,000 exclusion if you're married, or 3/5 of the $250,000 exclusion if you're single, which would be 150. Either way, it's a pretty good deal. And when they changed the 1031 rules, they also said that if you did a 1031 exchange into it, you would not be allowed to take the principal residence exclusion on that property that was your replacement property for 5 years. So they changed the principal residence exclusion to kind of lock out the principal residence exclusion on that property for 5 years. Of course, the longer you stay in it, the longer you hold the tax man at bay. And it's important to note that because the principal residence exclusion does not exclude gains from recapture of depreciation. So there would be a little sliver of gain that you would still have to pony up for, because the principal residence exclusion primarily excludes the gains from the appreciation in value, not the depreciation that was due to those deductions that you took for the theoretical wear and tear in the property. So I think you have two options. You could do the defer, die strategy, or you could defer, buy an oceanfront condo, rent it out for a few years, and then move into it, make it your primary residence, live in it for at least 3 years, and then sell it and take a portion of the principal residence exclusion.
Hey, Jeff, Reed Johnson has a question. He says he bought a home to fix and flip, but his daughter ended up living there for 8 years. Now he's looking to sell and he's wondering if he can 1031 this house. He didn't depreciate it and she paid market rent.
Oh, she did pay market rent. I thought that the facts were going to be worse than that. You know, putting a roof over your kid's head, it does not make it an investment or business property. But having a lease with your kid and having them pay market rate rental and having them really pay you the rent checks every month might make it so that it's considered eligible for 1031. I would have Reed talk to the accountant, because I'm worried that if they weren't taking depreciation, they may not have been deducting the property taxes and other business related expenses that relate to the property, because depreciation is the big one, but property taxes, insurance, other expenses that relate to the business use of the property are all deductible. And it may be a bad optic to try to do a 1031 exchange when all of your prior tax returns have not shown any rental activity on the property like depreciation. So that might be one of those nebulous areas where they need to go back and amend the prior tax returns and clean them up so that they're more consistent with having owned it for investment or business, which will then help them qualify for the 1031. But a lot of people that I talk to want to buy properties like by Arizona State University or by UMD up in Duluth. They were looking to buy a property so that their children can live in it during college, so they don't have to be moving their kids in and out of the dorms and having to deal with COVID restrictions in the dorms. They just want to buy a property for their kids to live in. Well, does that make it an investment or business property? Maybe, particularly if they're renting it with 5 or 6 of their friends and you've got a whole bunch of co-tenants on the lease and everybody's paying rent. Just because you're renting to a relative doesn't make it a personal use property, but it does perhaps raise an eyebrow of suspicion that it may not be investment or business. So really have a written lease, have it be at market rate, and really collect the rent. Really walk like a duck and talk like a duck is kind of my perspective, if you want to qualify for 1031. Any other thoughts or questions, Carrie?
I don't have any. Reed, did you get your question answered?
All right. I want to talk about the enthusiastic lender for a second. Let's say that I sold a property for $1 million. I paid off a $600,000 mortgage, and I have $400,000 of cash in my exchange account. Now I want to go out and buy a property for $1.2 million. My enthusiastic lender is able to go like really high on the leverage. And I say to the enthusiastic lender, hey, thanks for that enormous qualification for the mortgage, but I've got $400,000 of radioactive cash. If I touch that cash, I'm going to get burned with the recognition of gain. So the first priority is to reinvest the $400,000. Then I don't want to borrow any more than the bare amount needed to get this purchase closed. Even though you are an enthusiastic lender and willing to loan me more, I want to put the brakes on that and only borrow the $800,000 needed to complete the purchase. And so it's really important that when you're talking to your banker, they understand that even though you could qualify for more debt, you don't want it. You only want to get as much debt as is needed to make up the difference. You got to get your cash into the property. Well, a lot of investors are going to their banks and saying, look, I'm going to buy this property, and immediately after I buy it, I'm going to rehab it, or I'm going to reposition it. I'm going to need some money for those repair costs, remodeling expenses or whatnot. And the banker is trying to do them a favor and loan them more money than they need for the purchase and kind of roll the cost of the rehab into the purchase loan. And twice in this last week, I've had to send people information about why over borrowing at the moment of purchase is a bad idea. Instead, I would recommend first you do a mortgage just for the bare purchase price needed to get the thing acquired and be able to show a Polaroid snapshot to the IRS that your $400,000 of equity really existed in the property. And then in a subsequent event, amend the loan to increase the indebtedness or put on a second to pay for the rehab expenses. Now, the banks are just trying to do their job. They're trying to enthusiastically give you as much credit as you can get, but there is a snafu with when you're doing a 1031, you need to break that into two separate parts. And they'll say, well, look, it's going to be more expensive. You have to do 2 title closings and we have to print our loan documents twice. Well, yeah, but that expense is nothing compared to the expense of mucking up your 1031. And I used the M, not a different letter at the beginning of that, but you get the idea. Don't muck up your 1031 because your lender was overly enthusiastic in extending credit to you. Okay. All right, Carrie, we're at the top of the hour and I want to be, respectful of everyone's time and so forth. So I'm going to kind of leave it open if there's any other questions and suggest to you that the most important thing that you need to know is my phone number, which is on the screen now, 612-643-1031. I'm on the phone all day long. That's all I do is talk to people and be a sounding board and resource for telling them about our services and how we can act as a qualified intermediary given their specific situation. And I often collaborate with their accountants and their attorneys to help craft the solution that they're trying to achieve. And I love to work with young entrepreneurial investors that are getting started in this process. Now, we can't do 1031 exchanges on flips because flip properties are basically held for resale and inventory is excluded from 1031. So once those entrepreneurial investors have moved beyond flipping and now they're into the holding and renting stage of their careers, I come in and help them basically reduce their effective tax rates to 0 by deferring their gains and rolling those gains into the next property. Thank you, everyone. Oh, one question here.
Do you have a text that you could recommend? Your presentation has been excellent, but it is to me a bit elevated for me to really, retain. And so I'm wondering if you have any textbooks or books of any kind that you would recommend.
Certainly, the Minnesota State Bar Association has a desk book on real estate transactions. One of the chapters in that desk book is on 1031 exchanges. It was authored by a local Minnesota tax attorney named Paul Lindstroth. That is probably available at your local law library. There's a law library on top of the Hennepin County Government Center. That would be a place that you could get some free information. Also, there's a very good tax treatise written by a California tax attorney named Mary Foster. That book is called Tax-Free Exchanges. It's also available in many of the law libraries in the Minnesota area. I think there's one at the University of Minnesota Law School, and I think at Mitchell-Hamlin Law School, and I believe at the Hennepin County Law Library. But call those law libraries in advance and make sure it's available before you go over there. Those are great books to get the sort of, base level stuff that you're looking for. Also on our own website, CPEC1031, I have lots of videos, explainer infographics, and just stuff on our blog post that talks about 1031s.
By desk book, do you mean reference book that cannot be checked out?
I think it's actually called a desk book. I think that's what they call it.
Okay. One quick question. When I bought my duplex years ago, I was of the impression that the woman who sold the duplex to me wanted to stay on as a renter because she had lived in it and rented out the side that I moved into. It was a condition of sale that I allow her to stay. After a year, I learned, she moved, but I learned that she did that to avoid capital gains. And I have since been told that can't be true. There is no such allowance. To your knowledge, is there a scenario where in an owner-occupied duplex, if I sold it but conditioned the sale on remaining in the unit for some period of time, that I would avoid capital gains? Have you ever heard of that?
No, that's a complete mystery to me.
Okay.
I don't know why she wanted to stay on, but I doubt it was for tax reasons.
Okay.
Good question, though.
We got a couple in the chat here. Somebody's looking to demo and rebuild a single family to triplex for either long-term hold or split and sell. Any thoughts on if a 1031 comes into play?
You're really swimming upstream if you're trying to build improvements on land that you already own. I'm just going to say that is a really tough row to hoe and leave it at that. They may want to find other sources of capital other than sales proceeds from relinquished properties to finance that demo and reconstruction. Because if you already own the land, the IRS generally doesn't view that as an exchange when you're just building improvements on real estate you already own. They want to stimulate the economy and have you go out and buy something new, i.e. exchange into something that you didn't already have. Good question, though.
Anybody else have any questions? I have a question for the attendees, but if you don't have any questions for Jeff, we can let him go about his evening. Anybody got anything? Jeff, thank you so much. I really appreciate it. I know it's a hard decision for people to make when you're facing a big tax liability. So
I want to encourage people to just give me a call and talk to me on the phone. I am happy to talk to anybody about our services.
thank you,
Thanks,
Jeff. I know
everyone.
you do a
Thank you,
good job.
Jeff. Good job.
Yes.
Thank you. Bye now.
So Jeannie told me she wanted this seminar or this informational thing a while back. So I was happy to oblige. And I'm wondering if anybody else has any requests. I had a thought that I do have a friend who's an agent who specializes in the Smoky Mountains and short-term rentals. If anybody wanted to learn about that, we could see if she'd join us for a Zoom call. I also have a friend who's an agent in Louisville, Kentucky, where they're getting better cash flows than they are here. Or if you guys want an accountant, I can try. I don't know if I'll have any luck between now and April 15th, but holler and I'm happy to tap into my resources and get you somebody to find out about what you want to know about. Anybody got any requests? You don't want me to sing, trust me. If not, I guess watch for emails about other things. Rent control. If you're a member of MHA, you may have seen the magazine that just came out. It's all about rent control in the Twin Cities. We'll see if we can get Marty to join us again and give us an update of where things are with the state legislature and the local city councils. So, oh, we get another message here. Sorry, I just want to make sure it's not something that everybody would benefit from hearing. Doesn't look like it. So anyway, everybody have a good night and I hope to see you all soon. Good to see you, Jeannie.
Thank you.
Thank you, Carrie.
Have a good night.